it's worth.
Hey, we're live. It is 6:45 Eastern, Sunday, the 23rd of August. It's another unmissable Sunday show. How are you doing, Benny?
Hey, buddy, how are we doing? Happy Monday for you.
Happy Monday for me. So busy weekend. I went into sort of futurism mode this week, and I put a piece out on Saturday, which, by the way, is free for everyone. Go to blindsquirrelmacro.com. It's on the front page. The World in 2046. No paywall on that because I want some input. So the challenge, which Ben and I are going to work on between now and late November, sort of Thanksgiving time, is to try and assemble a stock portfolio of 20 stocks for 20 years. Now, this is an exercise in trying to build a mosaic of potential, often competing macro and geopolitical outcomes or realities in 20 years' time. And then to score a universe of stocks against this mosaic of outcomes. And then we'll have a couple of other screening tools on top of that, with a view to putting together. It's more than an idea. It's not more than an idea totem. It's a basis. It's a basis of discussion. It's a basis of thinking sort of slightly non-linearly. And I think it'll be a really valuable exercise to go through. And Benny's fully engaged.
Absolutely. We were talking about it because we were thinking. I was trying to warn Rupert the dangers of prediction. I like that he threw the Yogi Berra quote that I like to talk about, and our friend Dredge likes to talk about in there. So you just remember, it's hard to predict the future. But I think like what we're trying to say is like, let's start thinking about it. It's a good exercise, actually. I enjoyed it, like just putting my mind through it. And Rupert did a really good job of saying, okay, here's my kind of process. Here's what I'm looking for. And like, we're gonna have a scoring system and you know, like not like, I love this, like what comes across and passes the test, if you will.
Absolutely. So the first thing I did is that took my mind back, if you like, to 2006, right? And I go, okay, what would have been, you know, the classic first derivative action in terms of building a 20 for 20 back then? So cast your mind back to 2006. China's been in the WTO for 5 years. Right, BRICS is the thing. We're all talking about peak oil. Mobile phone stocks are the ultimate GARP play. Home prices in the US, right, never fall in a correlated fashion. Banks and financials are almost a quarter of the S&P, and they're absolutely crushing it. We don't have iPhones. We don't have cloud computing. You know, there are a bunch of spotty gamers that know what NVIDIA is, but you know, that's about it. And I reckon you'd have come up with this portfolio, which would have had a lot of frankly stocks that I love now, like oil companies and miners. You'd have had a disproportionate amount of financials. You'd have probably owned the mobile phone handset stocks, which would have been a disaster. And then a bunch of consumer and China financialization themes. You know what? That portfolio kind of did okay, right? And I mean, if you, and this is a slightly unrealistic. This is deliberate.
Although most of the heavy lifting is the last couple of years, it did nothing for a while.
It was in a decade-long drawdown from literally,
especially on a real basis, most definitely, right? Like you probably had another, yeah. That's what happens. These things going out of favor, right? What's that old chart of the commodities versus stocks? You know, it's like the cycles that you go in, like over time, and it makes sense. And we're now seems like we're in a commodity cycle, even though you know.
Well, listen, I mean, I stress again that this is an artificial exercise because this was an equal weight portfolio with no rebalancing, right? And you'll see when we get to the second derivative thinking exercise that created some crazy outcomes. But also on the first derivative, on the extrapolation basket, the lack of rebalancing. Well, if there'd been a simple annual rebalancing of that original book, the returns would have been 50% better, right? by the same token, and you get to our extrapolation basket, if you've done if you've done rebalancing on this one, the mosaic portfolio, your returns would have been cut in half. They would still been really, really impressive. And look, this is the two portfolios versus the so mosaic in green, the extrapolation in blue, and the S&P and global equities, the ACWI, in orange and purple, respectively. But you know, what were we trying to answer back then? Is you know, where were profits going to move? You know, we were betting on mobile being the future, but also betting that mobile was going to stay with the carriers and with the handset manufacturers, when in fact, you know, that with Android and with iOS, you know, the value chain sort of migrated to the software stack, right? We were underinvested in all matters of compute at that point in time. Listen, AWS was 5 months old in the summer of 2006, right? But Amazon was already profitable, had been since 2003. And AWS, whatever this new data storage business was internally funded, right? It was a bet that Bezos could carry on making internally. So there wasn't, you know, it would have been logical to think wider and to think about the opportunity on cloud at that stage in time. So fast forward to today, what are the various sort of mosaic of potential outcomes for 2046 that we could think about? And you know, I came up with these 10, right? And a lot of them conflict with each other, right? For example, you've got End of History 2. This is my joke about being a kid of Fukuyama, right? You know, what if this is a temporary aberration, this deglobalization, and we go back to normal, and we could ignore that multipolar spheres of influence outcome, right? What if, you know, there isn't, you know, a perpetual bottleneck problem with energy supply, and even though it's always been 10 years away, we have abundant fusion or geothermal energy, right? Then we need to think about, you know, debt, fiscal dominance, human longevity, the AI robotic world. We've got to talk about climate resilience as well, right? Which balance sheets underwrite and are destroyed by various outcomes on that front. And you know, and then of course we've got the dominant narrative today, which is human cognition at scale and in abundance, right? You know, who wins there, right? Who is it? Is it the data owners? Is it AI overlords? Are we in a world of rollerball when we're you know, the corporates are all in charge? I just think it's really interesting to think about the world through that prism. And so I want to do it systematically, right? And so all of the stocks that we sort of, you know, put on a long list for here need to be scored against this mosaic on a sort of systematic resilience card basis. And then there are some other ground rules which I wanted to employ, which was, you know, there needs to be a fundamental screen right now around the quality of income statements and balance sheets today in 2026. There is a evaluation screen, right? You know, I'm sure some version of Walmart's going to be around or Costco's going to be around in 20 years' time. But if you're underwriting that as a stock for 20 years, paying 50 times earnings for it in 2026, might not be such a great thing for overall returns. And so, you know, that's the exercise that kicked off this week, and I'm pretty excited about it. And as I said, you know, this full report is available for everyone, and a bit of fun. I've put together a downloadable long list, right? I'm in a small concession to efficient market theory. I've included the largest stocks in each of the major geographical market caps, and that's about 65 globally, which I've added to the long list of names that I came up with eyeballing this mosaic. But I'm really open to suggestions of new names and new tickers from people. And if anyone comes up, it's the first person to come up with a stock that isn't in the long list, they can become a free Squirrel subscriber for life. So
there we go.
send them in.
There we go.
Stick them in the comments. But the long list looks like this, right? So 125 stocks. You know, I ultimately want to put a single sector cap at 25% and a single country cap at 40%. Now, I think that the valuation screen is going to do a lot of the heavy lifting in terms of the pruning, because if you just look at the number of sectors that are trading on pretty, should we call healthy multiples here. I mean, let's face it, right? The almost 50% of the S&P right now is trading on more than, by market cap, it is trading at a double-digit sales multiple. So I think valuation is going to do a lot of the work there to make these country caps and sector caps easier to get to.
I think you're probably right. I mean, but again, prediction's hard. We don't know exactly how.
Well, no, but that's the point. Is the point is we're not making predictions. We're putting together a mosaic of, at times, completely conflicting potential outcomes for 20 years' time. And so, you know, take, for example, let's say you think long reserve life Canadian oil sands energy company, right? A Cenovus or a Suncor, right? That's not going to be looking pretty great if we do actually get commercial fusion, right? You know, that long reserve oil sand asset's going to listen, we're still going to need plastics and a whole load of other stuff.
We still need to transport. So I don't know if that's true, but yeah. I know your point. Your point is innovation can change things. You know, like Google search is not as valuable as it was 5 years ago, is a point, right? You know, even though ChatGPT 2 and 3 were already out in those old days. And by the way, it was such dog shit back then. But the point is taken is that there is a lot of the distribution of outcomes for the next 20 years probably is as wide as it's ever been in some ways. You know, like you could go back to 2006, which Rupert did, and say same thing. And I do think it was fair. But I mean, although it was obvious, at least to this guy, that we were going down first. But like I would have never like thought that it would have played out the way it did. And so you never really know. But like I do think that energy always is the number one thing to start with, like, because that is the fundamental, you know, capital of society, humans and energy. That's like where you start any economic or any conversation with.
Well, I mean, if you've got compute cognition against the human stack, and you've got new technology in the form of fusion against the traditional energy stack, you know, you still got to have that debate, which is why I'm enjoying this process and exercise. But I mean, I agree with you, right? Energy, 2.5%.
Still need energy to do that compute, though, right? I mean, it's still energy is the foundation of all the economy. Humans and energy, that's the foundation of the economy, basically. Like, you know, it's the first principles, if you will.
I'm totally with you there. Now, listen, you wanted to talk about Grok and Cursor, didn't you?
I did.
And you, whether or not this is Elon's Instagram moment. I'm using my
just so everyone knows, the Squirrel has even though he pays for his blue check on there, and I'm trying to get him to use the Grok, like he has a bias. But yeah, so look, if you guys remember when let's say it was early April, Rupert, right? When we did that first report on SpaceX, like in front before it was the filing. Then we did another one when the filing came out, and we were kind of all over that. And then we had your buddy Craig on right the day before the trading. And so, you know, that whole process was interesting because, you know, we saw that they started leasing out their Colossus to Anthropic, and then after it came out about Google, but what we were like, Grok is terrible, and they were firing all their Grok people. Now it comes out, you know, 4 days after the IPO was done, they bought Cursor. Oh,
Well, they had an option on Cursor pre-IPO, right? People that
I don't
wasn't.
remember the exact date, but
Yeah,
yeah.
no, they had this option on Cursor. They played a jumbo break deal, deal break fee to Cursor, because they wouldn't be able to close it unless they'd gone public. But it was out there, and so
Okay,
it's
okay, okay,
very
okay. Okay.
it's very very clear that they were getting rid of their native engineers because they had a
Yes.
plan to replace the team,
Yeah.
which is the team that's behind this new improved version of Grok, right?
And our friend of the show, Tom Roderick, had argued to me in the spring that he was like, look, this Cursor deal is going to be what saves these guys. He's like, that's going to look real cheap at 60 billion. And it's funny. So it made me think about another IPO when I was a young buck. And I don't know, maybe Rupert allocated me some stock. I got a good allocation on the Facebook IPO.
No, I told you the Facebook story because I was in Hong Kong, so I wasn't involved
Oh,
directly.
okay.
But I was speaking to our head of retail at the time of the Facebook IPO about a different thing, about a Hong Kong China name that we were bringing to the US markets, and he said, oh, "By the way, I've just got my allocation for Smith Barney from the lead left on Facebook. Do you want any Facebook stock? Because you can have as much as you want."
Well, I sold mine up. I sold it before it went down to deal. So for what it's worth, but that deal was always like the whole thing was, oh, you're not on mobile. Most of these economics are on the desktop, right? Because we were transitioning. That was the time when mobile was really taking off and iPhones were getting big, etc. And obviously everyone knows how Instagram worked out. I put that chart on there. I mean, that was like a 300 or 400, 500 bagger on $1 billion investment. Not that easy to do, and so good for Zuckerberg. But I started questioning because Grok 4.5, 4.6 has gone like where I'm using that all the time. That was unusable not that long ago. And if you look, it's on the Pareto frontier. Like it's right up there in terms of intelligence versus cost, in terms of, basically, look, it's number 3 right there on the list.
Mm-hmm.
And like that was not a thing. And I talked to some engineers on Friday at various AI firms, like who work at the firms that are on that list. And the assumption, the thing I heard was OpenAI, or Grok, DeepSeek, OpenAI were going to be the 3 winners. And it was strikingly crazy how people were moving away from Anthropic. And I'll tell you, like I've told people this over the weekend, a lot of people are kind of like blown away by that like comment. And again, it's one data point, but they do work on the forefront. I use this stuff. I moved from Perplexity and Manus over to the Grok. I got a Grok bot. It's pretty good. And that's all Cursor. So I'm just telling you that I think that and by the way, Facebook's IPO tanked. Just did like, SpaceX just did a nice 50% dump also.
Let's red team this analogy a little bit, right? So it was pretty clear that, there was a transition that Facebook needed to make to mobile back at the time of its IPO. Instagram was already an insanely successful mobile.
No, it wasn't. It had 0 revenue, 13 employees. Like, what are you talking about?
No. In terms of eyeballs and vision, if the vision of the future was advertising on mobile devices, it was pretty clear that was going to be an interesting property. Right?
Okay, well, it didn't have nearly the views. I mean, fine. It had the initial trajectory, but like, all I'm saying is Cursor is the same thing. Everyone talks about these are the smartest guys, and they are, and it's coming out maybe that this, we'll talk about it next, the Ox Arrow might be a Cursor model. And when I was in St. Bart's a couple weeks ago, I had 2 engineers of one of the guests' sons on both sides of me, and one of them worked there. And he's like, yeah, those guys, since they can, like, those are the smartest guys in the room. So I'm just telling you, this Cursor acquisition has made me change my view on SpaceX of being so negative. Like, it might be one of the best. But let's go to the Ox Arrow thing real quick, because we have to talk about that as well over the weekend. So on my chat I have for the subscribers, I have a couple guys, a lot of PMs. I've got a buddy of mine who was in AI, was on Wall Street. And so I wake up, I think it was Friday, and he goes, this Ox Alpha model might be a game changer. And I was like, what the hell are we talking about? And look, 9 trillion tokens in a day, and it just comes out of nowhere, and no one knows exactly, like everyone's guessing where it is. But like the point of this is not even about the Ox Alpha, because this could be the DeepSeek 2.0 moment. You never know. But that it's a knife fight out there, guys. Like these guys coming out of nowhere. It's just, I just told you about Grok comes out of nowhere. We thought that we were done. If you're talking about capitalizing things in LLMs, when it's just like next month, there's like a new dominant player coming out, like good luck on that. You know what I'm saying? And like, and I think that like financial guys are very like, hey, let me look at the data. It's backward looking. This is forward looking. And I'm trying to tell you is that I am now beginning more and more to believe that LLMs are going to eventually be free and just added on to the equipment.
Okay. Well, then you've just got to exactly where I wanted to go. This is fascinating watching, the battle of the LLMs. But why does that make you bullish about the economics of foundation model labs, right? So you just said that this cursor acquisition and integration with Grok makes you less bearish about OpenAI, but
okay, I see what you're saying. You're doing two different time windows. Yes. Okay. So I'm saying is cursor is gonna look. There's not gonna be. It's not gonna be free. Like the frontier will still get paid, right? The lower level guys will be free. Like let me condition that statement. Like, but the point is that you still have to. If I use Grok bot, like someone needs to pay for that to do all that work. That's not free. You know what I'm saying? Like it's just the capabilities of it. And so when we get to this point where who's using what, there's going to be some people who have market share. There's going to be a bunch of people who go out of business. And then there's going to be a lot of people who get a lot of it for free. Like, again, like we've talked about on the show, Apple's going to have a decent model and they'll call it Siri, and Siri will finally be useful for the first time ever. And like that's just an example. But like we had a little conversation on the chat this morning about local versus cloud. And that's a thing. And like, Rupert before the show was telling me he did a decent job of those graphics you saw earlier were from a local model, right? So golf clap to Rupert for being there. He doesn't want to pay the cloud. But like, this is what I'm trying to say is that it is a knife fight, and it is definitely not something where you could feel comfortable being super excited about what's going to happen. All I'm trying to say is that I reverted my view of XAI as being nothing but the data center neocloud valuation to like, oh wait, they actually have some real guys there, basically.
Yep. Yeah. I listen, it could well look like a small number relative to a big number future. I'm not sure it's quite Instagram, but let's see. Yeah.
And like I kind of came up with this concept of like thinking about when we were talking with Rupert of like, what are we not forecasting, right? Like it always is so hard, to see the future. And even if you like think about Eastman Kodak, right? Eastman Kodak, these guys created digital photography. So it's funny. I'm laughing, yeah. I guess. These guys created the technology that put them out of business, but they wanted to stay with their cash cow, right? And so sometimes when it's in front of your face, it's still even hard to see the future, right? Like when you created the technology.
Well, they wanted to alter the future by just sitting on the patents, right? And that never works.
Yeah, and I guess my point is that like that is kind of the disconnect that I think that is very present today is, everybody likes being a legacy winner, having good cash flows, boom times, it's easy, and want to let it go. And so the hyperscalers, what I kind of come to accept is that I think they realize they're creating a new utility class in essence. And, the truth is that maybe their business isn't going to be as good as it was, because remember, bankrupt telecoms, also the energy bankruptcies, some other guys did some of the CapEx for them, and now they just have to do it. And that is what capitalism is. And, when Rupert and I were talking about this, I was thinking this through, and I came up with this concept of compute feudalism, which I have a deck in the show notes for everyone who is a paying subscriber. And like, kind of is that's what it is, because as we had my man Tom Jens on here, Tom, since I guess maybe like November of 22, was telling me, he's like, dude, the interconnect and transformer backlog is insane, and it still is, right? That's 4 years ago, and it still is that. And like, basically, I think they understand that. That's why, like, Amazon bought some bankrupt solar field, and they just, everything they can get their hands on, because then there's nobody who can actually disrupt that business. Now, that business isn't as high of a return on capital business as the old business, but it's a new utility class, right, Rupert? Like, does that make...
Well, they still exist. They survive.
Exactly. Right. And existing and big money, still big money. Just, yeah, your ROIC isn't what it was, but still growing, and an important business that's central to how the world's going to work in the future. I kind of get it more. Like, yeah, they've gotten derated. I think that was a good call by us a year ago. Or actually, we didn't have the show. That was a private call by us. And they're going to get to the point, Rupert, where do we say, hey, it's gotten cheap enough, people are too negative? Like, that's what I'm kind of thinking. And it could be stock by stock, right? Like, so I'm not trying to blanket it, but I will say that, like, if this is the view and they're going to be there, regulated utilities, yeah, they're not exciting, but they're good businesses. And then you get a couple call options like Quantum and Waymo and whatever. Like, just whether I'm right or wrong, just entertain that idea.
Yeah, no, I hear you. And ultimately, it'll come back to, expected returns, right? And so, it's just good old-fashioned Brilliant Myers corporate finance. Ultimately, there will be a price at which this new form of utility, is attractive, right? But
yeah, I don't know.
It doesn't seem super sexy, and maybe there are smarter ways to play that same future, right? So if we set out this feudal compute system, right, there are going to be a sort of second or third derivative plays which have much better expected returns than sitting with a new form of regulated utility.
And so I guess what I would just add, and again, the deck kind of has a winners and losers place in it, but you think about, until we have power not be the bottleneck, like, that will be the ultimate. Like, we had my buddy Amish on in early or late May, and he was pretty much adamant that, whoever has the power of the neo clouds is in better shape, or the hyperscalers, obviously. And then my buddy Tom was like, well, we could reorganize the grid and we have enough power. It's like, but yeah, no utility is going to do that. Like, they laid the transmission lines. Those guys are the original OG rent seeker, right? Like, they want the money to come in.
But they have to build 50-year DCFs, right? So they cannot rebuild without surety of tenancy and surety of flow, right? And I don't think the industry is offering them that yet. It's totally commercially sensible that they don't move, that they don't reorganize the grid.
Yeah, absolutely. And but that's what I'm saying. That's my point.
That's rational capitalism.
And lobbying against new competing assets that might come up, transmission lines or new generation, like that happens. In, like, not sexy. You gotta look. You gotta pay attention to that kind of stuff. But, like, I guess that's kind of the point. Is the physical layer is definitely asserting itself in a way that hasn't been present in a long time. Like, we have not, in my lifetime, had it. I lived through. I'm 44, turning 45. Lived through the decapitalization in terms of physical capital in the West, and like, maybe we're just re-entering the physical capitalization. Commodities had a good run, but, like, maybe this is, like, going to be different, like, animal than we thought in the past, and that software, LLMs, anybody, neoclouds like CoreWeave, or short power, like, anybody, like, they're not in a good place, because you're going to have to try and capture a margin, but a margin on a moat that might not be there. And so, what is the sustainable moats in this new world? And I think that's kind of what we were thinking, right, Rupert, right? Like, of the shifting dynamics of profit pools, in essence.
Absolutely. And that's going to be the big theme of this piece of work. which, just to remind everyone, is running between now and Thanksgiving. Points mean prizes for good ideas. Stick them in the comments. If you hey, listen, let's keep Margot happy. Can we please get everyone to follow us on the Instagram, please? That would make Margot very happy. Anyway, I think that's a wrap at the half-hour mark.
Right on
Anything
the
you want to say?
dime. Right on the dime.
Right on the dime. I think it's Benny and the Squirrel, Sunday, the 23rd of August, and we are out.